Hello students, welcome to Brilliant Group of Institutions, Qatar. And here I am today, the next section of Class 12 Accountancy, Term 2 Examination, Chapter Retirement of a Partner, with another adjustment, that is Accounting Treatment for Goodwill. In the last class, I had explained to you in detail as to how to calculate the new profit sharing ratio and the gaining ratio. Now today, I am going to explain to you adjustment number 2, that is the accounting treatment for goodwill. Now this accounting treatment for goodwill is not a new concept for you children. This particular concept you have already learned while learning admission of a partner as well as change in profit sharing ratio. But when it comes to retirement of a partner, there is a little change. So today we are going to look into as to how you are going to treat goodwill when a particular partner retires. Now before I go on further, we would be doing the concept of accounting treatment for goodwill. We will learn as to why treatment of goodwill is required. Then we will learn as to what are the two different cases of treating goodwill and how to pass the journal entry. Before we go on further, I will explain to you a small example. There are three friends, that is, one is Amar, Akbar and Anthony. These three friends were thick friends. They had a very strong relationship. You can say that they were very, very good friends. And one day, they decided that they are going to start a particular business. So, around 15 years back, these three friends started a business. And they put in so much of hard work and they worked very hard. They put in their whole time, their energy, their effort, and they continued doing this particular business. And it so happened because of their continuous hard work and their effort, etc., this particular business started flourishing. The goodwill of the firm started increasing. The reputation and the image of the firm started increasing, or you can say it started increasing in the market. People started coming to know about this particular organization. But after 15 years, so basically for 15 years, they carried on their business. And after 15 years, Anthony, a partner, decides to retire. Now, the reason as to why he wants to retire is because he feels that he's become old and he wants to rest. Now, if Anthony retires and goes, the share of Anthony will be taken over by Amar and Akbar. So they will be benefited by Anthony's retirement. But one thing you need to remember, children, the goodwill that the firm has earned is because of the continuous and joint effort of all the three partners, that is Amar, Akbar and Anthony. And it wouldn't be fair if Anthony just walks out of the firm without anything. And the remaining partner, Amar and Akbar, are benefited by his share. So, in accounting, whenever a partner retires, the partner will take his share of goodwill. Now, the question arises, if the partner will take the share of his goodwill, who is going to compensate? Definitely, it is the benefiting partner or the gaining partner who is going to compensate or provide to the retiring partner. So in this particular example, if Amar and Akbar is benefited or if they are gaining, then both of them will compensate Anthony, the retiring partner. But if it is only Akbar who is benefited or who is gaining, then it is Akbar who is going to compensate the retiring partner, that is Anthony. So in a nutshell, you can say that because of the joint effort or the goodwill was created, so the retiring partner has to get a share of goodwill. And who will provide? It is the benefiting or the gaining partner who is going to provide goodwill to the retiring partner. So the retiring or the deceased partner is entitled. Now in case of retirement, and death, the treatment of goodwill remains the same. Okay, is entitled to his share of goodwill at the time of retirement or death because the goodwill earned by the firm is the result of the continuous and the joint effort of all the partners in the past. Okay, so when a partner retires, the continuing partners gain his share, and since they are gaining it, the continuing or the gaining partner have to compensate the retiring partner for his share of goodwill. I hope this particular concept is clear to you as to why you have to treat for goodwill in case of retirement of a partner. Now let's see, children, there are two cases in case of accounting treatment for goodwill. Now what are the two cases we are going to learn in detail? Now the accounting adjustments adopted to treat the goodwill in the account depends directly on the fact that whether goodwill appears in the book or whether goodwill does not appear in the books. So there are basically two cases. Case one that you have is when the adjustment for goodwill is made through partner's capital account, or you can say when goodwill does not exist in the book, or you can say when goodwill account is not open. And the second case is when goodwill already appears or exists in the books. Now when I say already appears or exists in the books, it means that it will be shown in the balance sheet asset side. Let's try to understand what is the journal entry and why is the journal entry being passed. When adjustment for goodwill is made through partner's capital account, or when goodwill does not exist in the book, or when goodwill account is not open, in that case, the journal entry that you have to pass is gaining partner's capital account debit to retiring or sacrificing partner's capital account, being goodwill adjusted through partner's capital account in gaining ratio. Now the question arises, why is the gaining partner debited and why is the retiring or the sacrificing partner credited? Children, the gaining partner is debited because they are the one who is going to compensate, or they are the one who is going to provide for goodwill, or you can say they are the one who is going to give goodwill to the retiring or the sacrificing partner. And the retiring or sacrificing partner is credited because they are the one who is going to receive the amount of goodwill. So the journal entry in case of when goodwill is adjusted to partner's capital account, or when goodwill account is not open, or when goodwill does not exist in the books is gaining partner's capital account debit to retiring or sacrificing partner's capital account. The next case that you have is when the goodwill is already appearing or existing in the books. That means it is already there in the balance sheet. That is called as the existing goodwill. Now this particular topic is not something new for you because you have done it while doing change in profit sharing ratio as well as admission of a partner. Now here again the journal entry when goodwill already appears in the books, then in that case you have to write out the goodwill to all the partners in case of retirement and death of a partner. So the journal entry will be all partners capital account debit to goodwill account. Now this existing goodwill is written off in the old ratio to all the partners in case of retirement and death, being existing goodwill written off in old ratio. So these are the two cases in case of accounting treatment for goodwill. That is, one is when goodwill is adjusted to partner's capital account, and second when goodwill already appears in the books. Now next we are going to solve few problems. So try to understand it well. A very easy concept, not difficult at all. You just need to keep these two journal entries into your mind and you have to just remember that while treating the goodwill. Now in the first question that you have is P, Q and R are partners. They are equal partners, children. It's already given they are equal partners. So when the question says they are equal partners, that means it is 1:1:1. Who retires? It is R who is retiring. And the goodwill of the firm is valued at rupees 3,60,000. No goodwill appears as yet in the books. That means there is no existing goodwill at all. P and Q agree to share future profits in the ratio of 3:2. That means the old ratio between the partners is 1:1:1 and the new ratio that you have is 3:2. Pass necessary journal entry for goodwill. Children, whenever they ask you to pass the necessary journal entry for goodwill, first thing that you need to see in the question is what is the old ratio? Second thing to see in the question is whether the new ratio is given, because if the old ratio and the new ratio is given, you have to find something called as your gaining ratio. Third thing you have to see in the question, what is the value of goodwill? So it's clearly given in the question that the old ratio is 1:1:1. The new ratio is 3:2. The goodwill is valued at 3,60,000. So step number 1 is you calculate the gaining ratio. So calculation of gaining ratio. You have 3 partners, that is P, Q and R. The old ratio is equal. So that is 1:1:1. And who retires? That is R retires. Okay, and the new ratio between P and Q is 3:2. We already learned that the formula for gaining ratio is new ratio minus the old ratio. This is what we learned in section 1 in the earlier class, where I explained to you in detail how to calculate the new profit sharing ratio and the gaining ratio. So the gaining ratio is new ratio minus the old ratio. In that case, for P, it's going to be, so that's 3/5 minus 1/3, which is equal to 9 minus 5 divided by 15, which is equal to 4/15. So in case of P, the new ratio is 3/5 and the old ratio is 1/3. So 3/5 minus 1/3, you cross multiply this 3 into 3, that's 9, and 5 into 1 is 5. So 9 minus 5 divided by the LCM 15, you get 4/15. In case of Q, it is 2/5 minus 1/3, which is equal to 6 minus 5 divided by 15, which is equal to 1/15. So the gaining ratio that you have is 4:1. Is this much part? I hope this is clear to you. The next step that you need to do is calculation of R's goodwill, share of goodwill. Now, what is the goodwill of the firm given? The goodwill of the firm, of the firm is valued at rupees 3,60,000. So goodwill is equal to rupees 3,60,000 and R's share. So what is R share? R share in the question is 1/3. So it is 3,60,000 into 1/3, which is equal to rupees 1,20,000. This 1,20,000 will be distributed in the gaining ratio, that is 4:1. By whom? P will give 4 part and Q will give 1 part. So the goodwill amount of R is 1,20,000, which has to be in the gaining ratio, that is 4:1. So the journal entry that you have is, who are the gainers? You have P's capital account debit, Q's capital account debit, to R's capital account. P and Q are the gainers and R is the retiring partner, being goodwill adjusted to capital account. In which ratio? In gaining ratio, that is 4:1. So the R's capital that you got is 1,20,000. 1,20,000 you distribute in 4:1. So you have is 1,20,000 into 4 by 5 and 1,20,000 into 1 by 5. So you get is 24,000 and then you get is 96,000. So the journal entry for Goodwill in this particular question is gaining partner to the retiring partner. Who are the gainers over here? P and Q are the gainers and R is the retiring partner. Our share of Goodwill is 1,20,000 and that is distributed between P and Q in the ratio of 96:24. So it is P and Q who is compensating R with 1,20,000 in the ratio of 4:1. Let's go on to the next question. The next question says A, B, C are sharing profits in the ratio of 3:2:1. So you have three partners over here. The ratio is 3:2:1, which is basically the old ratio. Goodwill is appearing in the books. So Goodwill is already appearing in the books. When they say Goodwill is already appearing in the books, it means that in their balance sheet already Goodwill is there. And if Goodwill already exists, what we are supposed to do is we have to write it off to all the partners in the old ratio. So Goodwill is appearing in the books at rupees 2,40,000. And B retires. It is B who is retiring. And on the day of B's retirement, Goodwill is valued at rupees 6 lakhs. So Goodwill is valued at rupees 6 lakh and A and C decided to share the future profits in the ratio of 3:2. So the new ratio is 3:2. As I told you earlier, the first step you need to look into your question is what is the old ratio? That's 3:2:1. What is the new ratio? That is 3:2. Okay, so from the old and the new ratio, what you're going to get is something called as the gaining ratio. And the formula for gaining ratio is new ratio minus the old ratio. So first thing that you're going to calculate is calculation of gaining ratio. You have three partners A, B and C. The old ratio that you have is 3, 2 and 1. The new ratio that you have is who retires? B retires and the new ratio is 3:2. The gaining ratio that you have is, as I told you, gaining ratio formula is new ratio minus the old ratio. Please put it into your head, children. A very, very important formula both for retirement and death of a partner. It can be asked for 1 mark question too. So it's new ratio minus the old ratio. So in that case for A, it is 3/5 minus 3/6, which is 18 minus 15/30, which is equal to 3/30. In case of C, it is 2/5 minus 1/6, which is 12 minus 5 upon 30. 12, how did I get? 6 into 2 is 12, cross multiply, and 5 into 1 is 5. And the LCM is 30, so it's 7/30. So the gaining ratio that you have is 3:7. The second step that you need to do is calculate B's share of Goodwill. Goodwill of the firm. Goodwill of the firm is how much? So Goodwill is valued at rupees 6 lakhs. And B share is equal to 6 lakhs into his share is 2/6, which is equal to rupees 2 lakh. Now going on to, so this particular 2 lakh will be distributed in the gaining ratio, that is 3:7. So the first journal entry which you have is Goodwill is already appearing. So for that we will write it off to all the partners in the old ratio. So the entry will be A's capital account debit B's capital account debit, C's capital account debit to goodwill account. Existing goodwill written off in old ratio. So what is your goodwill? Goodwill is appearing in the books at 2,40,000. This 2,40,000 distribute in the old ratio. So you get for A, it is 2,40,000 into 3 by 6. So that's 1,20,000, 80,000 and 40,000. So for B it is 2,40,000 into 2 by 6, and for C it is 2,40,000 into 1 by 6. So that is 1,20,000, 80 and 40, which is distributed to the partners in the old ratio. The second journal entry which you have is to be adjusted. That is, goodwill is valued is given in the question. So we already calculated. So the amount that we calculated is 2 lakh in the ratio of 3:7. So the entry will be A's capital account debit, C's capital account debit to B's capital account goodwill adjusted in gaining ratio, which is 3:7. So your B's capital that you have is 2 lakh. 2 lakh into, it's 3 by 10. 3 by 10, and this is for C, it is 2 lakh into 7 by 10. So 3 by 10 is 60,000 and 7 by 10 is 1,40,000. I hope this particular concept is clear to you all, but even then we will do few more problems. Okay. In this question, they're saying that A, B, C are partners sharing profits. So there are three partners, A, B, C, sharing profits in the ratio of 4:3:2. B decides to retire, okay, and he surrenders his share to A and C in the ratio of 3:1. So he is surrendering his share in the ratio, he is surrendering his share. That means he is giving. If he is giving, whom is he giving? B is giving to A and C. What is B's share? B's share is 3 by 9. That 3 by 9 he is giving in the ratio of 3:1. Okay, that means they are gaining. So what is the gaining ratio? There is no need for you to calculate the gaining ratio because gaining ratio is already given in the ratio in the question, that is 3:1. Now in the question they are saying the goodwill of the firm is valued at 1.5 years purchase of super profit. This particular chapter is from valuation of goodwill. Okay, so basically the question can be asked this way too. Okay, so you have to calculate goodwill on the basis of purchase of super profit method. Okay, and based on average profit of the last 3 years, which were 2 lakh, 2,40,000 and 3,10,000 respectively. The normal profit is already given in the question as 1,70,000 and goodwill already appears in the books at 72,000. Already appears in the books, has to be written off between the partners in the old ratio. But before that, we will have to calculate what is the goodwill. Okay. So first thing that you do is calculation of goodwill. This is through super profit method. Okay, so in that case, the first thing that you need to calculate, step number 1 is calculate your average profit. So your average profit is equal to the total profit upon number of years. So AP is equal to, what is the profit of last 3 years? 2 lakh plus 2 lakh 40 plus 3 lakh 10 divided by 3, which is equal to 2 plus 2 4, 4 plus 3 7, 7 lakhs 50,000 divided by 3, which is equal to 2,50,000. This is your first step when it comes to super profit method. Calculate the average profit. And what is the formula of average profit? Total profit upon number of years. The second step that you have is, what is your normal profit? Normal profit is already given in the question. So normal profit is already given in the question and it is rupees 1,70,000. So 1,70,000. The third step is super profit. The formula for super profit is the average profit minus the normal profit. So super profit is equal to average profit minus the normal profit, which is equal to 2,50,000 minus 1,70,000, which is equal to rupees 80,000. So that is your super profit. Now you find out is your goodwill. Goodwill is equal to super profit into number of years of purchase. And what is your super profit? Super profit that you have calculated is 80,000 and the number of years of purchase given in the question is 1.5. So which is equal to rupees 1,20,000. Now this 1,20,000 is the goodwill of the firm. Find out what is B share. B share is equal to 1,20,000 into his share is 3 by 9, which is equal to rupees 40, which is equal to rupees 3 ones are 3 threes are 3 ones are 3 fours are 40,000. This 40,000 will be distributed in the gaining ratio, which is 3:1. I hope this much is clear to you all. Now going on for the journal entry. First journal entry that you're going to pass is goodwill is already appearing in the books at 72,000. So any goodwill appearing in the books or which appears in the balance sheet asset side, you have to write it off to all the partners in the old ratio. So the entry would be, so A's capital account debit, B's capital account debit, C's capital account debit to goodwill account. Existing goodwill written off in old ratio. And what is the goodwill? The goodwill that you have is 72,000. In the old ratio is 4:3:2. So in that case, what will A get? 72,000 into 4 by 9. 72,000 into 3 by 9. That's what B gets. And C gets is 72,000 into 2 by 9. So in case of A, 9 8s are 8 4s are 32, 8 3s are 24 and 8 2s are 16. So the existing goodwill is being written off to all the partners in the old ratio. The second entry that you have is gaining partner to the retiring partner, and B is retiring. So the entry is A's capital account debit, you have a C's capital account debit to B's capital account. Goodwill adjusted in gaining ratio. So that you have is 40,000 and gaining ratio is 3:1. So that's 40,000. So how much does A? In case of A, it is 40,000 into 3 by 4, that is 30,000 and 10,000. So I hope this is clear to you all. A comprehensive question where you have a mixture of valuation of goodwill as well as retirement. Okay, so you have to first calculate the goodwill by the super profit method and then find out the retiring partner's share, and that retiring partner's share is distributed, or you can say is distributed in the gaining ratio to the gaining partners. Let's go on to the next question. That is, A, B, C are partners sharing profits in the ratio of 1:4:3:2. D retired and the goodwill is valued at rupees 2 lakh. D share of goodwill is to be adjusted into the capital accounts of B and C, who decide to share the future profits in the ratio A, B and C in the future profit sharing ratio 4:3:3. So in this question, 1:4:3:2 is your old ratio and 4:3:3 is your new ratio. You have to pass necessary journal entry for goodwill. So the first step is you calculate the gaining ratio. So calculation of gaining ratio. You have 4 partners A, B, C and D. The old ratio that you have is 1:4:3:2. 1:4:3:2 where D retires, and the new ratio that is given is 4:3:3. Now the gaining ratio formula that you have is NR, that is the new ratio minus the old ratio. So in that case, for A, what is A's new ratio? A's new ratio is 4/10. A's new ratio is 4/10 minus the old ratio is 1/10. So his gaining ratio is 3/10. In case of B, it is 3/10 is his new ratio and the old ratio is minus 4/10. So here you have this particular partner B is sacrificing, because in this particular case his share has become negative, that is negative 1/10. So he is a sacrificing partner. He is not gaining but he is sacrificing. In case of C, C is equal to 3/10, that is a new ratio minus 3/10, which is equal to 0. That means C is neither gaining nor sacrificing. So in this particular question, it is only A who is the gaining partner, whereas you have something called as a sacrificing partner, that is B, and C is neither gaining nor sacrificing. So now the second step is calculation of goodwill. What is the goodwill of the firm? The goodwill of the firm is given as 2 lakh. So from that 2 lakh, you have to find out is the retiring partner's share, that is D. So D's share is equal to 2 lakh into 2/10. So that's 40,000. And you also have to find the sacrificing partner share, that is B's share. So B's share is equal to 2 lakh into 1/10, which is equal to 20,000. So now the journal entry in this particular question is going to be the gaining partner to the retiring partner to the sacrificing partner. Who is the gaining partner? It is A who is gaining. And who is the retiring partner? It is D who is retiring. And who is the sacrificing partner? It's B who is sacrificing. So the journal entry in case of this particular question is going to be A's capital account debit to D's capital account to B's capital account Goodwill adjusted through capital account. So you have is in case of D, that is D share is 40,000. That's what we found out, and B share we found out is 20,000, and A is a gaining partner with 60,000. So in this particular question, there is a small twist, that is you have is the gaining partner to the retiring partner to the sacrificing partner. So these are the different questions of goodwill in case of retirement of a partner. I hope you have understood it well. We'll be back with the next adjustment in the next section. Till then, goodbye.
Brilliant Qatar, your trusted coaching partner for IIT, JEE, NEET, Science and Commerce tuitions with 10 years of excellence in quality training. Brilliant Qatar.